Hi everyone, welcome back to the S&P 500 valuation analysis for early January 2025. A happy new year to everyone who is listening to this update, and I do apologize that I'm a couple days late with the holiday period and the new year. Things got pushed back just a little bit, but happy to be back. There's a lot going on, so let's dig into it. First off, again, just the regular disclaimer here. This information is my opinion only. Certainly is not financial advice, and please consult a financial professional for your specific situation or if you have any questions that you'd like to have answered. And finally, just a little bit of housekeeping. Why are we doing this? What are the objectives of this analysis? Really what we're trying to do is determine the relative attractiveness of the S&P 500, really try to understand that risk-reward ratio and balance and what makes sense given the current environment. We do this by doing a high-level top-down discussion. We look at common S&P 500 relationships and ratios to try to make that determination of attractiveness. And really, at the end of the day, this analysis is rooted in quantitative and objective measurements. We really try to take out the emotions, any of the commentary that you might hear on other channels. We try to just keep it very clear and very simple here. All the analysis that you'll see is using publicly available information, so everyone here can do this yourself if you're so inclined. And again, the goal is to provide a twice-a-month update in the middle of the month and the end of the month. Again, we're a little bit behind at the first of the year, but hopefully we'll get back on track. So let's keep moving forward. Let's look at the S&P 500. Again, the long-term graph here is shown over the past 60 years. But I want you to pay attention to the embedded graph looking at the last 6 months of the S&P 500. This for me is a proxy of the 200-day moving average that I like to look at. And really what you'll notice on this small graph is a little bit of choppiness, a little bit of unevenness, especially as we've gotten into the fourth quarter and started the new year. We've seen quite a few good days. We've seen some more bad days than we've seen in recent history. So I would say it has gotten choppy. And look, in full disclosure, I don't really like to look at day to day when I'm doing this type of analysis. But it is helpful just to look at momentum a little bit and try to understand where there seems to be a lot of tailwinds or there does seem to be some resistance. And it does seem like the chop has increased and just the day-to-day volatility has picked up some. So let's also look at the bond curve, the long bond, and the yield curve. And this is something that has moved quite a bit. So if I think back to the video I did in early December, I think long bond yields had dipped down somewhere close to 4.3, 4.25%, something like that. But since that time, if you think now to about the last 30 to 40 days, long bond yields have ticked up considerably. And as I'm making this video, the long bond, the 30-year bond, has reached about 4.9%. So it looks like we're making a run close to 5%. And this matters. This is a meaningful difference from where we were a month or two ago. It's a very meaningful difference from where we were several years ago. And we'll talk a little bit more about this and how movements in the long bond yields affect stock valuations, affect the tailwind or the headwinds that are impacting the S&P 500. So very quickly, just some context looking at the price to earnings ratios. I like to plot three of them here, both a typical price to earnings ratio, one on an operating earnings basis, another on a reported earnings basis. I tend to favor the reported earnings as I think it's a little more realistic in terms of what's happening in the market. And I've also added the CAPE on here, or the cyclically adjusted price to earnings ratio, or the Shiller ratio, as it's more commonly known. And again, I've shown this over the past several months. These ratios are elevated, particularly the CAPE, I would say, is quite high, as we approach 40. The price to reported earnings, the price to operating earnings continue to flutter around 30, which, while it's not the highest it's ever been, it is certainly higher. And again, in the context of long bond yields, which we'll look at why this is important. And so, in the context of the long bond, we just looked at the chart, which shows on a price to reported earnings ratio of around 30. The long bond price to earnings ratio is now approaching 20. And you might ask, how do you come up with that long bond price to earnings ratio? Quite simply, it's just the inverse of the yield maturity of the long bond. So if you have a long bond, a 30-year bond that is approaching 5%, I take the inverse of that, the PE ratio, where I can put the S&P 500 price to earnings on the same basis as the long bond. That long bond now is approaching 20. And so you're starting to see a disconnect. You've seen an inflection point happen within the last 12 to 18 months. And now you're seeing that gap widen, where the price to earnings ratio of the S&P 500 is around 30. The price to earnings ratio of the long bond is around 20. And again, this matters. This implies that the S&P 500 is becoming disconnected from really where it should be on a fair value basis. And why is that important? I'm going to show this graph that I've shown the last couple of times. This shows you the impact of the fair value price to earnings ratio, or what we should expect the fair value to be at different interest rates. And I've started this at 1% and carried it out to 15%. And I've broken this into three categories. You can see by the green, the yellow, and the red. The green section is what I would consider low interest rates, or interest rates that are 3% or lower. The yellow section is what I would consider moderate interest rates. This is where we are today. Or another way to think of this is transition interest rates. This is what I would classify as interest rates between 4 and 6%. And then as you move into the red section, this is what I would consider higher interest rates, or interest rates that are above 7%. Today we are squarely in the camp of those moderate interest rates of 5%, around 5% on the long bond. And again, this implies a fair value price to earnings stock ratio of around 20 on the S&P 500. So if you hear people anchor on, a fair value PE of 15 or 18 or whatever that number is, you really need to put some context around that, because the long bond yield matters. And, to give you an example, when we were moving out of COVID, or when we were, moving into COVID, and long bond yields moved down significantly. They were, I think, between 1 and 2%, maybe around 1.5%. And you can see the impact on this graph. Why did stocks have such a runway to go higher? Why did they have such a tailwind over the last several years? Well, when the long bond is under 2%, that fair value price to earnings ratio for the S&P 500 goes up dramatically. Again, this line is not linear, it's exponential. And so at an interest rate below 2%, that fair value price to earnings ratio goes up to 50. If it goes towards 1%, it goes up towards 100. And so stocks had an incredible tailwind, for several years that has now, that air has come out of the balloon a little bit. And as the long bond yield has moved up towards 5%, it makes a significant difference. And again, today we are, where I think a fair PE ratio is closer to 20, and this puts quite a lid on where stocks can move from here. So let's spend a little bit of time talking about the equity risk premium, taking those long bond yields, what we talked about, and then taking the difference of the earnings yield of the S&P 500. And this is an important graph. This is one of the most important in this deck, I think. And what it's telling you is, as that equity risk premium continues to decline, and you can see it has declined pretty remarkably over the past 12 to 24 months, we are now approaching negative 2%. And this is a pretty less attractive environment for investing in stocks. As we came out of the financial crisis, as we went through the decade, 2010 to 2020, came out in the COVID period, all through that period, the equity risk premium was pretty favorable for stocks. You could see it was, around 2%, plus or minus a little bit, depending on the time period that we were in. And accordingly, if you look back, really over the past, 10 to 15 years, stocks have really been on quite the run, take away sort of the COVID shock and all of that stuff. But by and large, stocks have had an incredible tailwind. And again, as that long bond yield has increased, it has put pressure on the equity risk premium, which is now clearly negative. It is approaching negative 2%, not the lowest it's ever been, but it is in an area where I think is concerning and certainly worth paying attention to. I want to finish up with a couple of common ratios. We'll look at the S&P to 500 price to dividend history first. None of this will surprise you. Again, all of these are quite elevated. Not the highest it's ever been, which was reached during the tech peak back in the late 90s, but we are right around 80. on a ratio basis, which again is quite high. Moving forward, looking at the S&P 500 to GDP ratio, this is the Buffett indicator as it's more commonly known. This ratio is very high. This is pretty concerning. A ratio that tends to hover either side of 0.1 has now clearly breached 0.2, so sort of twice its historical average of what I would consider fair value. This is concerning looking at this. This tells me that it's going to be difficult for stocks to move meaningfully higher from here, and there is certainly some downside risk when you look at this ratio. And then finally, looking at the S&P 500 to book value, again, clearly we have reached, and I don't have as much history here, this goes back to the late 90s or the tech bubble, but we are again broaching that 5 level on a ratio basis. Whereas historically, if you wanted to call something fair value, you might say either side of 3 is something more reasonable. So again, we find ourselves quite elevated here, and this is something that's worth paying attention to as we move forward. So what does this all mean on a fair value basis? And this graph, seeks to show you just over time where I would consider fair value of the S&P 500 versus where the index is today. And you can see, we've hit an inflection point. A couple things I want to point out, as we ran up and got into the COVID period where interest rates plummeted, as we talked about earlier, the fair value of the S&P 500 rocketed higher. It got above 9,000. And as a result, again, for several years, the S&P 500 had an incredible tailwind, and you can see it moved up quite a bit to try to match that fair value estimate. But as the long bond has increased and has moved substantially higher, that fair value estimate has plummeted. The inflection point has happened. Fair value now has reached closer to 4,000, while the S&P 500 has continued to run and cleared 6,000. So we've hit quite the disconnect here, and it continues to widen, right? The S&P 500 continues to have some momentum even with that chop. Fair value, as the long bond continues to go higher, continues to have pressure and move lower. And so, we are pretty disconnected at this point in time. So just to wrap up on my summary slide, as I'm making this video, the current value of the S&P 500 is right around 59.50. Depending on the day, it's moving up and down a little bit, but I show fair value right around 4,000. Now, when I started making these videos back in mid-November, fair value was closer to, I think 4,400, maybe even 4,500. But the long bonds have moved considerably higher, which has pushed that fair value estimate even lower. And as a result, I show the S&P 500 a little over 47% overvalue. So again, fair value a bit over 4,000, the current value just under 6,000. The risk-reward ratio appears, pretty unbalanced. Substantial downside risk that I would say. Again, the long bond yields have moved up around 50 basis points since early December. That has put pressure on our low value estimate, our fair value estimate, excuse me. And if you look down at the bottom here, I try to take those metrics that we've talked about in this video, the equity risk premium, the ratios of the S&P 500 to GDP, to the dividend ratio. How does it look on a PE ratio basis? And you can see that 6 of the 7 are flashing red. As a matter of fact, I moved the equity risk premium from yellow to red to make this video. And 6 of the 7 are flashing red. The only one flashing yellow at this point is the PE ratio, which I would say is still elevated. It's not as high as it's ever been, but it is elevated. So look, at the end of the day, we're in a period where I can't tell you where the market is going to go. I can tell you that the risk-reward ratio, or the risk-reward balance, appears strongly in favor of moving lower, right? I just don't see a lot of upside potential in this market given where we are today. Certainly if bond yields would move a lot lower, that would give us some tailwind, but bond yields continue to push higher, and as long as that's the case, I think we're going to be in an environment that doesn't appear particularly compelling or even neutral for investing in the S&P 500. So anyways, I hope you found this video helpful. If you liked it, please give me a thumbs up as we continue to try and grow the channel. Again, apologies that we're a little bit late in producing this due to the holidays, but I hope to get back on track here shortly. And good luck investing to everyone. We'll talk to you next time.